The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organization mentioned in this podcast.
Okay, it is Friday the 23rd of May. Jeremy, good to have you back.
Hi, Gareth. Good to be here.
And yeah, the sun is shining. We've got a bank holiday weekend ahead. So
yeah, we have, haven't we? Long weekend.
All is well. So in terms of the week, there's been a fair bit going on. Do you want to wrap up quickly what's gone on the global stage?
Yeah, well, not much as usual. We had the Moody's decision over the weekend, I think it was, to downgrade the US government's creditworthiness. And as Scott Besson, I think, correctly pointed out, credit ratings are inherently backward-looking things. And in fact, Moody's was probably, in comparison to S&P and Fitch, about a decade behind the curve because they downgraded US creditworthiness, I think, as far back as 2011 or 2013. So it was never going to be a specific catalyst for markets, rather more of a reminder of what investors already knew. And I think as a consequence, this US government indebtedness has become what Ben Hunt would call a common problem. And all this was going on at the same time as Trump's big, beautiful bill. And for the avoidance of doubt, I had to check. It really is called that. And it's had various twists and turns, but it's finally got approval. And this bill can be seen as, depending on your view of the world, as a U-turn by the Trump administration on fiscal restraint, or perhaps just confirmation that they never really believed in fiscal restraint anyway, and this whole Doge thing was just political theatre and political headlines. So the big, beautiful bill is going to cost the US taxpayer $5 trillion over the next decade, in an administration that's already running a fiscal deficit that's something like 7% of GDP.
Yeah, so they're taxing less and spending more. And presumably the bond markets have noticed that fact.
Well, yeah, of course. It's all those pesky bond vigilantes, and they were at it again all this week, creating havoc at the long end of the yield curve. So if we just recall, Scott Besson, he wants to term out and refinance his maturing bond market, and just at the place he'd like to term it out to is suddenly becoming more expensive. And this week, the 30-year yield has pushed decisively through 5% and looks like it's going to stay there for a while. I think he and Stephen Mirren now understand that for all the criticism they landed on the previous administration and its concentration on the short end of Treasury issuance, they were doing that for a reason, because the bond market, when confronted with reality, just has puked up.
Yeah.
And this is a global phenomenon. It's happening in the UK, it's happening across Europe, but where I think the focus is landing is in Japan, which now has 30-year yields above 3%, and it's certainly the highest level it's been in over 25 years. And why Japan? Well, Japan's inflation is running at over 3.5%. I think it was 3.6%. So Tokyo has not just got the slowest economic growth of any economy in the G7, but also its highest inflation rate. It also has, as we know, more than twice the average level of debt to GDP than any other developed country, and is the largest owner of everybody else's bonds. I mean, it is, as I've said before, like a hedge fund masquerading as a nation state.
Yeah.
But it's not a surprise that Scott Besson has taken it as his personal interest in making sure there is a deal in place between the US and Japan. And it would appear, because unlike the UK, Tokyo has not done a deal with the US, Japan is holding out for a lifeline for its industrial base, for its car makers that are going to be absolutely pummeled by the proposed tariffs. And I think they're using their $1 trillion holding of US treasuries as a bargaining chip.
So if Trump kills the domestic Japanese car makers or other industrial base, then they'll start selling their US bonds.
Yeah, and I think that's where the rubber hits the road in all this, in terms of the much talked about trade war becomes the much more potentially damaging capital war between countries that used to be all part of the club of cozy central bank controlled exchange rates and bond markets. And this is the underlying damage that is caused when the world loses control of the long end of its bond markets.
Well, and it's happening now.
I think it's happening now. I think it's in real time. But
Okay.
don't want to be too alarmist, but
No.
I think it is the big thing at the moment. And I don't personally see how they put this one back in the bottle.
Okay. So while that's going on, it sounds like we've rejoined the EU.
Yeah, buried somewhere. We did rejoin the EU this week, which will be a relief for many people, I'm sure. We've had a deal between London and Brussels, between the UK and the EU, first since the decision for the UK to leave the EU. But in reality, like all these things, it was more of a memorandum of understanding than a trade deal. But I think in essence, these are political maneuverings in order to set the scene for closer cooperation. And I think in all seriousness, this is a political move for the UK to participate in the now expanding European arms procurement and defence budget process. And to do that, we've made some concessions. And the headline grabber is we've let the French have some of our scallops.
Okay. What other UK news has been going on? We've had some inflation data.
Yeah, UK inflation for April came in at 3.5%, which was well ahead of March's 2.6%. It was sort of quite well flagged, but it was above expectations. And I think the worrying sign was that services inflation came in at 5.4%. So goods inflation by definition was significantly below 3.5%. Which I think most people have been focusing on. And of course, the services inflation reflects increased employment costs, which we know are going up since last year's budget changes. Mm-hmm. But also this inflation data reflected increased water and energy bills. But with the public sector looking for even bigger pay increases and the government U-turning on some of its welfare spending cuts also this week, the UK's fiscal situation has clearly deteriorated again. Part of this is that, we had confirmation that the UK's borrowing in April was higher than expected. Month to month, this is volatile data, so maybe we shouldn't put too much emphasis on that. But it's a straw in the wind and it's a concern. And just to help things along, we got a bit of a move up in the oil price this week on the back of Middle Eastern escalation fears, with reports suggesting that Israel is about to go it alone and strike Iranian assets. And we don't need that one right now, thank you.
We don't know. I mean, sure, products and price of oil can go up and down, but it is feeling like the wage rate increase expectations are just becoming embedded across the economy.
Yes.
People are looking for a decent annual pay rise in a much more aggressive way than I think they have for probably many years. So if that gets embedded, that's a real problem.
I think, to be fair to the UK government, I don't think this is a UK specific issue. I think part and parcel of geopolitical fracturing and deglobalization is that pendulum is swinging from capital back to labour, and capital had it good these last 25 years.
Yeah. So trouble on many fronts globally. So what would you say is the big market takeaway from all of this uncertainty and worries, in particular about the bond markets and persistent inflation?
If my theory is correct, and we're in a period where I think we're seeing the global authorities are losing their normal control of the bond market, these release valves away from the controlled financial system are going haywire. I mean, gold is up, whatever it is, 25, 30% year to date. Bitcoin has been in a slightly different place, but rallied to an all-time high this week. And while these concerns have increased, we've seen the dollar fall. And that is counterintuitive, but just brings back this idea that the US is having its own version of a Liz Truss moment. Now, for a Liz Truss moment, you can just say an emerging markets moment. This is classic, an emerging market crisis for what is the world's largest, most developed economy and the issuer of our reserve asset in terms of its bonds, all that stuff we've talked about ad nauseam. It does seem to be playing out. So, It's bond yields and escape valves. That's what I think the sort of takeaway is. But amidst all this, bringing it back to the UK, this week, the UK equity market actually managed small gains. The equity markets generally were quite resilient. I think the key feature of the UK, and bringing it back to sort of the UK small and mid-cap space, is that the further you go down the scale of the UK equity market, the stronger the performance. So the FTSE fledgling index was up 3.5% this week. So there is increasing signs of life among what have been, by many people, just written off as illiquid basket cases for a number of years now. And I think that the value opportunity for a UK investor is among some of the wreckage at the bottom end of the UK small cap market, if I might term it that. But as we both know, what people do term as the wreckage, there are some real gems that are just completely ignored.
Yeah, ignored mainly because they happen to be small in many cases, and it's just sort of where they are. And it's really interesting, actually, because from the progressive client base, we've had 3 bits of news this week, all of them really okay. We had SDI Group, Forterra and IDOX. So first of all, we had a trading update from SDI Group, which is a mini conglomerate manufacturer of mainly scientific instruments. They had a trading update for the year to the end of April. So it's quite recent, quite timely news. And it was pretty positive. They had a strong H2 across the back half of that year, with performance really beginning to pick up. So that was pretty well received by investors. The price was up 10% across the week. We had a bit more news from the house building sector. Forterra, the brickmaker, gave us a relatively upbeat trading update with their AGM. They were talking about revenue up 22% year on year in the first 4 months, which is a really strong number. I think there were some specifics within that in terms of the comparisons and some of the detail. So you wouldn't want to extrapolate that. But it does show that forecasts, I think we're running at 8% growth for the full year. So as our analyst, Alistair Stewart, suggested, that does suggest there's scope for upgrades later in the year if they can maintain anything like this rate of performance. And then thirdly, IDOX, which is a maker of software for the public sector. They had a half-year update, also up to April, so again, quite timely. And they were talking about good growth in both revenue and adjusted EBITDA, and even better growth in terms of order intake. So a nicely in line and reasonably positive update from IDOX there. And I think that's really the conundrum at the moment, is we've got pretty good news coming through from a large number of very lowly valued small and micro cap stocks in the UK. And there is definitely opportunity there. There's decent performance. We've talked about these companies being more resilient now than they have been for many, many years. They've been through a lot. They've got their own houses in order. They've got their costs under control, and they're starting to generate really decent performance across many, many sectors. Question is that strength or is that valuation opportunity going to be enough to make it an exciting investment space, given those big macro concerns that we've been talking about? And I guess the jury's out on that, but that's the key decision for the next probably 6 or 12 months, isn't it?
Absolutely. As you were talking, I was thinking, well, the normal criticism of this end of the market is that it is illiquid. And one person's illiquidity is another person's mispricing. And
Yes.
Liquidity and illiquidity are very difficult terms to pin down. But I think the value definitely exists down here. Whether that value can be drawn out fully in a macro environment that we've described, I don't know. But I think to have an exposure to value equities and your choice of escape valve from the big macro risks on the surface, I think is probably a good combination. Obviously, not investment advice.
No, but interesting to think about. So yeah, fantastic. Okay. And in the short term, what's happening over the next week or so?
Couldn't really see much for next week. We got some US GDP data towards the back end of next week, where we're going to get confirmation of a negative Q1 GDP print for the US. But I think that's pretty well known about and priced in here. But that's really about it. I think the main focus of market attention is going to be on the longer end of the yield curve and how to escape it, and whether your chosen asset is gold, Bitcoin, other precious metals, or some other form of alternative asset. The bond market is probably not the place to be for widows and orphans in the foreseeable future.
It's not normally the place for widows and orphans, and certainly not at the moment. So no, completely agree. Good stuff. Thank you for that, Jeremy. Great to catch up as ever. And we'll look forward to chatting this time next week.
Okay.
Talk to you then.
All right.
Brought to you by Progressive Equity.